If you are self-employed and you think your tax problem starts with deductions, you are already negotiating with the wrong enemy. Most people do not get crushed because they lack hustle. They get crushed because they keep running a business as if they own 100% of it, while a shadow partner has been standing in the room from the first dollar, hand out, contract unsigned, waiting to collect. That shadow partner is not dramatic. It does not send you a sales pitch. It does not clap when you land a client. It does not tell you that you are building freedom. It just takes its share from your active labor and lets you discover the damage when the return is finally in front of your face. I have spent my life studying incentives, ownership, and the difference between what people think they own and what they actually control. And I can tell you this, the self-employed make one expensive mistake again and again. They celebrate independence on the revenue line and ignore dependency on the tax line. You call yourself your own boss. The return tells a different story. Here is the brutal truth. A lot of self-employed people are not small owners yet. They are still employees in disguise, except now they are responsible for both halves of the payroll system. They moved from visible employment into invisible burden. They traded withholding for surprise. They traded structure for shock. They traded the comfort of seeing only one side of the tax for the pain of seeing the whole machine at once. That is why the first tax year hits so many people like a brick. They say, I only made $50,000. Why does it feel like I am being taxed like a criminal? Because your eyes are finally open. When you were a W-2 employee, the government still had a shadow partner in your labor. You just did not feel the full grip. Roughly 7.65% of payroll tax touched your side, and another 7.65% was quietly paid by your employer. The pain was split. Half was hidden before the money ever reached your account. The other half never felt personal because it arrived as routine withholding, not as a bill with your name and your blood on it. Then you become self-employed, and the curtain drops. Now you are both the worker and the employer. You are both sides of the handshake. You are both chairs at the table. Social Security and Medicare do not disappear just because you printed your own business card. The tax did not become new. It became visible. And visible pain always feels bigger than hidden pain. That is why so many freelancers, consultants, creators, solo operators, and early service business owners spend years obsessed with write-offs while missing the main leak in the hull. They are polishing the furniture on a boat that is taking on water from the engine room. I want you to understand the system the way I would understand a business acquisition. I would not ask what slogan the owner is using. I would ask who gets paid first, who gets paid second, what kind of income is actually being produced, and whether the economics are tied to labor or tied to capital. That is the whole game here. Self-employment tax is a labor tax, not a branding tax, not a motivation tax, not a paperwork tax, a labor tax if your income exists because you are actively working in the business. The shadow partner is attached to you. It is attached to your effort. It is attached to your services. It is attached to the hours, the meetings, the consulting, the coding, the designing, the selling, the managing, the producing. This is where ordinary people lose the plot. They think all income is just income. It is not. A wage is not the same as a return on invested capital. Schedule C profit from your own active work is not the same as passive ownership. Partnership income is not automatically shielded just because it sounds more sophisticated. An LLC is not a magic amulet. A rental property does not travel backward in time and erase taxes already attached to your labor. And a loss generated by somebody else's activity does not automatically pull the shadow partner off the income that your own body and brain produced. The tax code is many things confusing, political heavy, sometimes ugly. But it is not random. The system keeps asking the same question in different clothes. Is this money being earned because you worked or because capital's working? If you do not understand that question, you will keep buying costumes and calling it strategy. I have watched people do this for years. They form an LLC and feel clever. Nothing changes. They buy real estate and feel sophisticated. The wrong tax base is still intact. They open a second venture with losses and imagine the family return will erase the pain. The shadow partner keeps following the person who actually earned the active income. They spend 5 years chasing the words tax strategy while refusing to study economic substance. That is not tax planning. That is superstition with invoices. Let me make the danger personal. Imagine you earn $50,000 from consulting. You are proud, and you should be. You built something out of skill and will. But if you think that $50,000 is simply yours minus ordinary income tax, you are reading the wrong statement. There is another partner at the table, and that partner wants payroll, style tax on your active income, because in the eyes of the system, you did not just earn labor income, you earned both the employee side and the employer side of labor income. That is why self-employment feels like a tax bracket shock, even when the numbers do not seem huge. It is not always that you entered some monstrous income tax bracket. It is that you stopped letting an employer absorb part of the payroll pain and started absorbing the whole thing yourself. That difference matters psychologically. It matters strategically. And it matters commercially, because a business owner who misreads the tax structure will overestimate margins, underprice services, save for quarterly payments, and then blame success for what is actually a systems error. That is how a small business gets trapped. First rule, stop calling surprise a strategy problem when it is really an ownership problem. Second rule, stop calling visibility a punishment when it is really just a hidden cost that finally stepped into daylight. Third rule, stop chasing deductions before you ask what type of income you are actually producing. Once you understand the shadow partner, the noise starts to die. Now let me tell you what does not work, because there is a whole industry built around making desperate people feel intelligent while changing almost nothing. Real estate is the first fantasy. People hear that real estate has tax advantages, and that is true in its proper box. Depreciation can matter. Long-term appreciation can matter. Timing can matter. Rental income has different characteristics. But if you already have active business income exposed to self-employment tax, going out and buying rental property does not retroactively dissolve the tax attached to the consulting, freelancing, agency work, or service income you already earned. You are solving one equation and bragging about it to another. That is not the same as lowering self-employment tax. That is why I call it the wrong battlefield error. A lot of self-employed people are standing on battlefield A, getting shot from battlefield A, and then they run to battlefield B and build a beautiful fort there. Then they come back shocked that they are still bleeding on battlefield. A real estate may help your broader tax life. It does not automatically change the economics of your active Schedule C income. That distinction is where grown-ups make money and amateurs buy content. Then there is the LLC fantasy. This one is even more seductive because it feels official. You file papers, you get a state stamp, you get a nicer name, you tell yourself you are finally set up correctly, and maybe from a legal liability standpoint, some structure matters. But an LLC by itself is usually not a tax transformation, a one-owner LLC is often disregarded for federal income tax purposes. A multi-member LLC often defaults to partnership treatment. Active income does not stop being active income because you put it in a cleaner folder. This is one of the oldest traps in business. People confuse paperwork with economics. They think the entity changed the machine. Most of the time, they only change the label on the machine. I learned a long time ago that the market pays for substance, not packaging. The tax code, when it comes to labor versus capital, does much the same thing. If you are still the same human producing the same active income in the same economic reality, the shadow partner does not disappear because you bought a new binder. I call this the costume strategy. A costume strategy is when you change the outfit and announce that the business model has evolved. It is the financial equivalent of putting a tuxedo on a goat and calling it a racehorse. Then comes the most painful misunderstanding of all, the wrong base illusion. This is where people mix income tax planning and self-employment tax planning as if they were identical. They are not. A deduction can reduce taxable income without reducing the self-employment tax in the way you imagined. The details matter. Attribution matters. Ownership matters. Who earned the active income matters. Take a simple family example. One spouse has a thriving professional practice throwing off real active earnings. The other launches a software project or another business that produces large losses in the early years. On the joint return, those losses may affect taxable income in ways that look useful. But self-employment tax is still calculated based on who earned the active income. One spouse's loss does not magically remove the shadow partner from the other spouse's labor. That is a hard lesson because families think in one household statement. The tax system often thinks in activity, person, and character of income. If you do not understand that, you will keep expecting a family-level story to erase a person-level labor tax. It will not. And that is where the emotional damage sets in. Because the self-employed are ambitious people, they are builders, they are willing to take risk, they are willing to work late, they are willing to eat uncertainty for breakfast. So when the tax bill arrives and the tricks do not work, they do not just feel poorer, they feel betrayed, they feel fooled, they feel like the whole idea of ownership was oversold. But the problem is not that ownership was oversold. The problem is that labor was misclassified in your own mind. You thought you had escaped the employee system. In reality, you were still inside it, except you were now carrying both sides of the tax burden without the emotional anesthesia of withholding. That is why I say most self-employed people do not need more hacks first. They need cleaner eyesight. Once you have clean eyesight, the real levers become obvious. And here is where the conversation becomes serious. Because there actually are a few legitimate ways to change the outcome, not 100, not 1,000, a few. That is how real life works. The highest value moves are usually narrow, inconvenient, and tied to substance. The worthless moves are usually broad, sexy, and sold with confidence. The first real lever is capital return instead of service return. And one legitimate expression of that can be limited partner treatment when it is real. Notice the phrase when it is real, not when it is marketed, not when it is improvised, not when it is stapled onto a wish, when it is real. If somebody is truly a bona fide limited partner under state law and is functionally limited in management participation, then the distributive share can be treated differently because the economics look more like a return on invested capital than compensation for services. The system starts to see capital standing on its own feet rather than labor wearing a capital costume. This is not a free pass. It is not a toy. It is not for people who want to keep controlling, managing, performing, directing, and still pretend they are just passively receiving capital return. Substance matters, legal status matters, economic reality matters. That is the dividing line. The shadow partner is sticky around labor and less sticky around true capital return. That is the principle you must understand. The form only works when the function supports it. I call this the ownership test. If the money follows your hands, the shadow partner is close. If the money follows capital standing on its own, the shadow partner may loosen. That test alone can save you years of confusion. The second real lever is the S corporation, and this is where the internet has done tremendous damage by turning a nuanced strategic decision into a slogan. People hear one sentence, form an S corp and save taxes. That is like hearing one sentence. Buy a business and get rich. It sounds clean because it omits the part where the structure only works, when the economics support it. In an S corporation, you wear two hats. This is the right metaphor, because the hats matter. One hat is worker, one hat is owner. The worker hat has to be paid reasonable compensation for the services actually performed. That compensation is still subject to payroll taxes, which are economically equivalent to self-employment tax, just collected through the corporate system. The owner hat can then receive distributions on profit above that reasonable compensation, and those distributions are generally not exposed to payroll tax in the same way. That sounds attractive because it is attractive when the facts justify it. But timing matters, stage matters, profit level matters, compliance burden matters. If your business is too small, too early, too inconsistent, or too thinly profitable. Then electing S corporation status can create more paperwork, more payroll compliance, more administrative cost, and little to no meaningful tax benefit. Why? Because most or all of the income still has to come out as wages to satisfy the reality that the value is being generated by your labor. That is why I call early S-corp obsession the premature crown problem. People put a crown on a business before it has built a kingdom. Then they discover they bought ceremony instead of leverage. The most abused phrase in this whole area is reasonable salary. The internet treats it like a coupon code, 30%, 40%, 50%. That is not serious thinking. Reasonable compensation is not a fixed percentage of net income. It is tied to the value of the services you actually perform under, like circumstances. The question is not how profitable the company is. The question is what someone would ordinarily pay for that work. That distinction is everything. As the business grows, distributions may scale because profit grows. Wages do not automatically scale as some lazy formula of net income. If the service value is one thing and profit above service value is another, you can begin to separate labor from ownership more intelligently. That is not gaming the system, that is reading the system correctly. But if you are an early freelancer making modest profit and trying to force an S-corp election because somebody on the internet promised a big tax win, you may just be feeding lawyers, payroll providers, and compliance software while the shadow partner laughs. A structure is only a lever when there is weight for it to move. Remember that. The third real lever is where most people think they are operating, but usually they are not operating there with precision. Deductions inside your business can matter, but only when they actually reduce the net earnings from self-employment of the same taxpayer and the same active business reality. That means proper implementation, proper attribution, proper design, not vibes, not receipts in a shoebox, not a course on social media. If you are self-employed, real planning is not about collecting random deductions like trophies. It is about asking which deductions and benefit structures actually reduce the income base exposed to the shadow partner, and whether they are being used lawfully, intentionally, and in the right place. Retirement plans can matter. Health insurance can matter. Accountable plan structures can matter in the right setting. Depreciation can matter. Benefit structures can matter. But the key is not their existence. The key is whether they are connected to the active business and the same taxpayer whose net earnings are being exposed. That is why I call this the same pipe rule. Money has to move through the same pipe if you want the pressure to change where you think it will change. Most people are lowering one pipe and bragging that the other pipe should now magically feel less pressure. It does not work that way. The shadow partner is not emotional, it is mechanical. It follows active earnings, it follows attribution, it follows substance. That is why sloppy planning fails. Let me make the whole thing simpler. There are really only two broad worlds in this conversation. In one world, you are being paid because you are actively working. In that world, the shadow partner wants a piece because the income is labor. Linked in the other world, income is increasingly tied to capital, systems, ownership, and structures that are not simply a dressed-up version of your personal labor in that world. The economics can begin to change. That is the strategic journey, not from small business to bigger small business, from labor dependence to capital separation, from worker income to owner economics, from visible revenue to durable structure. That is the real upgrade. And if you do not see that, you will keep majoring in cosmetics. I am not telling you to worship complexity. Most people ruin their finances that way. I love simplicity when simplicity is honest. Low-cost index funds are simple and honest. A wonderful business bought at a sensible price can be simple and honest. A rational tax structure can be simple and honest too. But a simple lie is still a lie. And one of the biggest lies told to the self-employed is that cleverness beats classification. It usually does not. If the income is active labor income, start there, price your services accordingly, save for quarterly obligations accordingly, model cash flow accordingly. Do not pretend the bill is unfair just because you failed to include the shadow partner in your math. This is where strategy becomes character. Because most people do not want the truth first. They want relief first. They want the tax bill to be lower before they want the business to be understood. They want a trick before they want a structure. They want the sensation of progress before the discipline of clarity. That is why they stay stuck. I have said for years that what matters in business is not activity. It is intelligent activity. It is not motion. It is direction. It is not excitement. It is economics. Tax planning is no different. You do not win by doing a lot of things. You win by understanding which game you are actually playing. If you are self-employed and actively producing income with your own work, you are playing the active income game. That game comes with a shadow partner. The first victory is not escaping it instantly. The first victory is seeing it clearly enough to stop lying to yourself. Then you can ask the better questions. Is the business profitable enough to support a thoughtful S-corporation structure, including a defensible, reasonable salary and enough excess earnings to justify the administrative burden? Is there a real path for more of my income to become system income instead of personal service income? Are my deductions actually reducing the right base? Or am I celebrating noise? Am I treating legal entities like strategy because I do not want to confront business economics? Am I confusing tax content with tax control? Those are adult questions, and adult questions create adult outcomes. Here is another brutal truth. A lot of self-employed people do not actually have a tax problem first. They have a margin problem, they have a pricing problem, they have a structure problem, they have a volatility problem, they have a record-keeping problem, they have an identity problem because they still want to think like a scrappy freelancer while the numbers now require them to think like a disciplined operator. Self-employment tax simply exposes those weaknesses faster. It is a stress test. It reveals whether your business is a real economic engine or just a personal job with better branding. If the tax bill destroys you, sometimes that is not because the government was uniquely vicious. Sometimes it is because the business was never priced, buffered, or structured for reality. I do not say that to be cruel. I say it because denial is expensive. When I look at any enterprise, I want to know whether it has refusal power. Can it say no to bad customers? Can it survive timing mismatches? Can it absorb friction? Can it fund its obligations without panic? Can it distinguish revenue from owner earnings? Most self. Employed operators have very little refusal power because they spend from gross, think from net, save from leftovers, and plan from hope. That is upside-down thinking. You do not build freedom by spending first and strategizing later. You build freedom by treating every dollar as belonging to a sequence. Some dollars belong to operations. Some dollars belong to taxes, some dollars belong to reserves, some dollars belong to you. The people who survive understand that sequence. The people who fail keep acting surprised that the shadow partner took money that was never really theirs to spend. This is why I want you to stop using the language of punishment. Self-employment tax is not a moral judgment. It is not the government saying entrepreneurship is bad. It is the system saying labor. Linked income carries payroll-type burden, whether the payer is an employer or whether the payer is effectively you. Once you understand that, you stop taking the bill personally and start designing around it strategically. That emotional shift matters because panic makes people stupid. Panic makes them buy entities they do not need. Real estate they do not understand. Structures they cannot administer. And deductions they cannot defend. Calm operators do not do that. Calm operators read the machine. They ask, where is labor still driving the result? Where can ownership begin to separate from labor? Where is a valid S-corporation election actually warranted? Where are deductions really lowering net earnings from self-employment instead of just making me feel busy? Where is economic substance strong enough to support the structure? That is what strategy sounds like when adults are talking. And let me say something else that will save some of you a fortune. Do not let tax strategy become procrastination in a tailored suit. A lot of people study tax tricks because it feels more sophisticated than raising prices, controlling expenses, tightening contracts, improving collections, and building actual excess profit. They would rather spend 30 hours chasing a magic structure than spend 3 hours confronting the fact that their business does not yet have enough real margin to justify the structure they want. That is ego-wearing glasses. The truth is often simpler. If your business is early and thin, focus first on profitability, discipline, and clean books. If your business has matured and throws off profit beyond a fair salary for your work, now the S-corporation conversation may become serious. If your income is truly capital-driven and your role is genuinely limited, then the character of the income matters in a different way. If you want deductions to reduce the burden, make sure they are actually in the same active business pipe and lawfully implemented. That is it. Not flashy, not mystical, not viral, just valuable. And value is usually quiet. I built my fortune by respecting the difference between activity and ownership. A business that depends entirely on my personal labor is not the same as a business where capital, systems, brand, and position keep producing, even if I step back. Tax treatment may not be the only difference between those worlds, but it certainly notices the difference. So should you, because your real goal is not merely to lower one line on one return. Your real goal is to move from fragile income to durable economics, from labor addiction to ownership leverage, from accidental tax pain to intentional business design, from being shocked by the bill to pricing the bill into your model before the first dollar arrives. That is how rational adults operate. That is how you stop feeling hunted by the return. That is how you stop treating April like an ambush. And that is how you finally stop confusing independence with structure. Anybody can print an invoice. Not everybody can build a machine that understands where the money really belongs. So here is my test for you. When the next dollar enters your business, do you still think it is 100% yours until the government proves otherwise? Or do you finally understand that a shadow partner was standing there before you touched it? If you still think in the first way, you will keep living in shock, keep chasing costumes, and keep calling frustration a strategy. If you learn to think in the second way, you can start doing something rare. You can build with clean eyes. You can choose the right structure at the right stage. You can separate labor from capital over time. You can stop worshiping tricks and start respecting economics. And that is the real line in the sand. You can spend the next 5 years hunting tax folklore, or you can spend the next 5 years becoming the kind of owner who knows exactly who the business partners are, what each one is owed, and how to build a company that gradually needs less of your labor and deserves more of your ownership. One path keeps you performing for the shadow partner without understanding the contract. The other path forces you to read the contract, price the contract, and eventually redesign the business so that more of what you earn belongs to capital systems. And real ownership instead of exhausted labor. That door is open, but it does not stay open for people who insist on pretending they are already through it.